Hello everybody, and welcome to the most undervalued growth stocks video that I do every Friday. These are all of the stocks in my universe. So as a reminder, in this spreadsheet, I'm looking only at the next 12 months based on the guidance given by companies and my best estimates and also what the analysts say. And I'm looking at, based on the next 12 month expected growth, how much are we paying up for that growth, and knowing that the most important metric of this variable is the enterprise value over gross profit over revenue growth. And I'm looking at which company are you paying the least for each percentage point of growth. And so some companies you pay really nothing for the upcoming growth. Other companies, you pay a fortune for the upcoming growth. This stock is not, this spreadsheet is not a way to know total return, right? Total return is all about the long term, but it's a way for me to see which stock I like the most right now based on the most certain data we have, i.e. the data that is for the next 12 months. So that's kind of how I rank stocks. A few changes to the spreadsheet that I did this week is I added STEM because I'm getting more and more interested in STEM. And then I added these little crosses here. And so a red cross means that I've fully exited the stock because I'm unhappy with their direction. And a green cross means that I haven't entered the stock yet, but I'm considering entering it soon. Actually for Celsius, I sold the stock because it was a little high, and same for Nvidia. I sold the stock, but I put a green cross because I'm thinking about getting back in soon. Really, the only stock that I'm not thinking about getting back in anytime soon is Teladoc and Snowflake, because I've been very disappointed with either of these stocks' growth. But they are in my coverage universe. I've covered them on the channel, so I'm leaving them on the spreadsheet. So let's go. Which are the cheapest stocks right now? Well, there's been some changes to the spreadsheet, and there's 5, so I've updated as of today. There's 5 cheapest stocks, and this is getting usual. The market is still not noticing StoneCo by a long shot. StoneCo is the cheapest in my view, and HIMS. HIMS, despite reporting outstanding quarter, heavily sandbagged guidance that I've uploaded down here. I've put it down. The guidance is down. I've used all of the negative numbers HIMS gave us, and it's still the number 2 cheapest. So HIMS is extremely cheap, especially after the drop yesterday. You know, despite the fact that they had an outstanding 2025 guidance. Anyways, the stock is still very cheap. Pubmatic didn't do too well on their earnings, which means that they're way down. Now, Pubmatic, I put there, this is more of a riskier position. It's a teeny tiny stock. So for me, it's a very small position. I would not go heavy on Pubmatic. It's less than $500 million market cap. Then you have C Limited, which is extremely cheap right now, the cheapest of my e-commerce stocks. And lastly, we have Nubank, and I've seen a change between Nubank and SoFi, where Nubank is now the cheaper stock than SoFi. So these are the cheapest stocks right now. The most expensive stocks right now, for me, what are they? Well, they are Nvidia. Nvidia is still very expensive. I've completely sold out of Nvidia. I think it's too expensive. There's too much AI app right now. I'm slowly trimming Shopify, but I'm also well aware of the long-term returns of Shopify. So I'm going slowly now. I trim Shopify. And Etsy, I don't own Etsy, but it's on my radar, despite it being so expensive. I think Etsy has a very unique position in its platform, very unique position in the marketplace. So what I usually do is I will go through each stock in the spreadsheet and tell you my thoughts about each category of stocks. So, as you know, energy revolution stocks, that's my most heavily weighted category in this channel. In fact, most of the only 2 tier 1 stocks that I consider never ever selling is Tesla and Enphase. I'm extremely bullish on this. Energy underlies every single thing in our economy. It is the most important input of the modern world, and the most important economic input of a modern world is getting disrupted. And if I look at a change, actually Tesla and Enphase are trading pretty much more in line now that Tesla has dropped quite a bit. Enphase increased a little bit, and I decreased my growth expectation for Enphase to 50% just to put it in line with Tesla, because we have very, very little information on guidance with Enphase, but I'm very positive on both stocks. I added STEM. I've started to study STEM, and I'm considering buying STEM. STEM is a leading installer of power walls, of mega packs, Tesla mega packs. So STEM, I believe, has a lot of potential, and I'm still studying it. I haven't made the decision fully, but I added it to this spreadsheet. Then let me move on. We have the healthcare stocks. So HIMSS is by far, to me, the winner in this category. I might have to find something to replace Teladoc. Teladoc's growth is extremely disappointing, and despite that, Teladoc is more heavily valued on a growth basis than HIMSS. I much prefer HIMSS in this category. Then moving on to data warehouses, data monitoring SaaS stocks, I sold Snowflake. Snowflake has almost halved its revenue guidance. Customers are going pay as you go with Snowflake, and they're not signing big contracts. Plus, the latest cohort that they got in 2022 is not showing the DBNR that Snowflake has usually had for its cohort. I am very surprised by the almost 180 that Snowflake is showing in the business. I try to not fall in love with the stock. I liked Snowflake, but I was never really fully, very much into it because of the valuation. I was like, okay, I'm paying up a premium valuation for Snowflake because they have this stellar growth, because they have this 70 to 80% revenue growth, because they have 170% dollar-based net retention rate. This is gone. So now it's a 40% growth stocks. Well, guess what? I can get this with much cheaper companies like Datadog, for example. You can get this type of high-quality SaaS at a much cheaper valuation. Datadog or MongoDB are examples of, I think, good alternatives. So I sold my Snowflake position, allocated it to many other positions. Palantir is still a little bit more expensive, but if you watch that channel, you know that my position on Palantir is that I like the margin of safety of the military business. I believe Palantir over the long run could become the fourth military contractor of the United States, and it would be a software stock. So it has very high margin. So even though I'm not happy with the progress of Foundry with Palantir, I am very happy with what they do in their military sector and how well they're doing with the military software. So I think this provides a margin of safety which makes me sleep well at night, essentially. So that's why Palantir, I think Palantir is a good buy alone for the military business. Aside from all of the hype around Gotham, I like Palantir for a military business. So moving on, we have cybersecurity. So a big reason for getting into cybersecurity, investing in cybersecurity, is of course the recession-proof nature of cybersecurity. Zscaler reported its earnings yesterday. Zscaler did just fine, and people seem to be very disappointed with Zscaler, but I think it did just fine relative to its valuation. So I'm not worried as Zscaler. If you watch his channel, I was waiting to see the earnings of Zscaler to see if Cloudflare was a threat to Zscaler. I do not think so. I think Zscaler has found its customers and has a good focus on the market. So I'm resuming my buys of Zscaler. I still believe the cheapest stock in the cybersecurity space is CrowdStrike, and I can't wait to hear from them. And CrowdStrike is my biggest cybersecurity position out of all of these three, by a long shot, actually. Number one would be CrowdStrike for me, then Zscaler, and then Net is a tiny position. Net, I am fully aware, is highly valued right now, so that's why I'm waiting for a drop on this one. Then, moving on to e-commerce. So as you know, on this channel, I love MercadoLibre, but MercadoLibre kind of had a run up recently. So I am slowing down, and I've actually been adding to C Limited. I am liking the C Limited business more and more than MercadoLibre. If you follow this channel, in this segment that I am slowly trimming Shopify. I think Shopify is kind of expensive right now, so I'm slowly trimming Shopify, adding a little bit to other positions. But Shopify, I don't want to completely sell out of Shopify. I am fully aware of the long-term return that this stock has had. I think this stock has a lot of potential in the long run. Then moving on to payments. So StoneCo is still the cheapest payments company out there. Like StoneCo is kind of like 70% of a Square payments platform, and maybe 30% a kind of a ERP system for small business. Kind of an Intuit/QuickBooks for small business in Brazil. The Brazilian market is what Stone focuses on, and I just think this stock is dirt cheap. Cathie Wood and Warren Buffett own the stock, and this stock has been forgotten forgotten about by the market, despite showing very, very promising growth in the Brazilian market. So I like StoneCo. I've been adding to StoneCo. I haven't touched my Square position. Square is doing just fine. Square is doing well. Square is losing money because they bought Afterpay and they paid too much for it. And so the gains that they make from the Cash App and their payments business, they kind of finance the losses of Afterpay. But over the long run, I believe Square has a tremendous position to disrupt payment processors in the US and to really really hurt banks. I think Square could hurt banks as it becomes the direct deposit institution for so many younger people, like Gen Z are just doing direct deposit on the Cash App, and I believe this is very powerful stuff. DLocal, if you follow the channel, you know I'm waiting on DLocal. I'm waiting on their report. I still don't know what to do. They were attacked with a short report, and the stock has devalued quite a bit since that short, and I'm waiting for the other conference call to finally figure out what I do. It's a small position for me, so I'm not too worried about DLocal. It was an outstanding business before it got under attack by this short report, and I'm still waiting to hear. So chip makers have completely sold out of Nvidia. I think Nvidia is too expensive. They had an outstanding quarter. Everybody sees the Nvidia opportunity. I see the Nvidia opportunity too, which means that shareholders piled onto the stock. I've run up the stock, and I think that stock is just trading way too high. Yes, AI is going to be huge. Yes, there's about 4 times as many GPUs for CPUs in a rack server. Yes, the A100s are $10,000. There's a lot of good things going on for Nvidia, but everybody sees it too. Everybody sees the Nvidia opportunity too, which is why right now it is so expensive. I would look forward to get back into Nvidia if the stock were to drop, and hopefully that happens. But if that doesn't, that's okay. I much prefer AMD. I still think AMD for that space has a compelling valuation right now, and they are clearly hurting Intel. AMD is clearly getting ahead of Intel, and even though the CPU market is a smaller market than the GPU market, it's still a decent market, especially for devices and laptop and computers. These are gonna come back. Plus, AMD is a diversified company, right? They acquired Xilinx. They provide hardware for Xbox and all of these gaming platforms. So AMD is kind of a play on gaming, kind of a play on embedded electronics like Xilinx, and a player on CPUs. So I like AMD a lot, much more than Nvidia, especially at this valuation gap. Moving on to my ad tech. So the Trade Desk. I've owned the Trade Desk for a while. I'm not touching the Trade Desk, but it is expensive. I'm not adding there. I've been adding slightly, very, very, very tiny ads to Pubmatic, because I believe Pubmatic has a good position in the sell side platform, but Pubmatic is very, very risky with $500 million market cap roughly. It's just very risky, and I am waiting to hear more from this company. So I don't go too heavy on Pubmatic, but I much prefer Pubmatic right now. Even though Trade Desk is a great stock, I think it's too expensive. Right, that's of the highest range of my sector here. Moving on to lifestyle stocks. So lifestyle stocks, I actually sold out of Celsius, and I was lucky because I sold Celsius in the high hundreds, high $100 share price. So I was lucky. Celsius went back down. They've experienced a slowdown. They've seen a little bit of slowdown, which is not surprising. Celsius is not that cheap of a product, so it's not too surprising. But I would be looking to get back in if the stock price dropped further. If you saw my analysis on Celsius, there's a lot of similarities between Celsius and Monster Beverage, and Monster Beverage was literally one of the best performers of the past 20 years. For fundamental reasons why I would want to invest in an energy drink, right? Celsius has a lot of caffeine. People keep coming back to Celsius. But I'm out right now because I think it's a little expensive. Still, I follow the stock, and it's still on my spreadsheet. And then Figs. So Figs, I bought a teeny tiny position. It's probably the tiniest position in my portfolio. I bought Figs, and of course the stock corrected because they guided single-digit growth. And I need to study Figs a little more and see what's going on with Figs right now? Why would they guide such low growth? That is why the stock went down. But I believe FIGS over the long run has great potential, and at this price, right, at enterprise over forward gross profit of 2.77, yeah, it's dirt cheap at this price. And so does it have potential? Does it have competitor? In the scrap space, I want to look more into FIGS. Their European growth is absolutely insane. They're growing extremely fast in Europe, and the market seems to have entirely forgotten that now Europe is a bigger market than the United States. And demographics are such powerful trends, right? Hospitals are going to be in great need because of demographics. People want better scrubs, and so could FIGS be as big one day as Lululemon? Well, that was the thesis of a video I made on FIGS recently, and so I'm still waiting to see, but I may add more to FIGS shortly. And by the way, that should have been a yes here. That is a mistake, but it's a yes. They reported their earnings. Okay, moving on to Neobanks. So Neobanks, I've been focusing my buys on Nubank more than SoFi. I haven't touched SoFi, I haven't sold SoFi or anything, but more on Nubank. I think Nubank is becoming cheaper now relative to the growth that we have over the next 12 months. I also have a little bit of a fear for SoFi because we're going to hear back from the Supreme Court about these student loans lawsuits. And the media, the investing community still doesn't know that SoFi is not linked to student loans. And if, God forbid, the student loan moratorium were to be expanded again, which I believe it will. I believe student loans are not coming back for 10 years. I believe student loans is going to be like DACA. That's my working hypothesis for SoFi. But I can already see the headlines. Oh, extension of a moratorium as the Supreme Court rejects, or whatever Supreme Court. I just can't see those headlines come. And so I have a bad feeling that people are going to sell off SoFi again based on the student loan story, because most analysts, most of Wall Street have not dug into the stock, and they don't know that SoFi has pivoted away from student loans. So there's still that stigma, that association of SoFi equals student loans delayed, thus SoFi bad, thus I sell SoFi. Kind of a logic of a lot of analysts out there for a stock like SoFi. And I don't have that overhang, of course, as far as Nubank goes. Lastly, platform. So the only platform that I have is Airbnb, and I have to say I'm very happy with Airbnb. The stock is doing so well. The underlying metrics are doing well, right? It's they have more rooms than all of the hotels in the United States, and they're doing much better. And they have 82% margin. And it's an asset-light company. I think Airbnb is, as far as an example of how good a platform can get, Airbnb is it. Platforms are obviously a new type of business model, which is very, very powerful. I'm interested in platform. Powerful platforms include, say, Amazon's e-commerce marketplace. That's a platform. YouTube is a platform. Platforms are so powerful. And so that's why I'm interested in investing in platform. I'm looking right now at Etsy and Fiverr. I believe these could be very, very interesting stocks, but I have not taken a leap yet. I haven't bought these stocks yet, but I'm following them on this channel, and I'm trying to expand my portfolio of platforms. Platforms are superior business model. It's a business model play, right? It's just like SaaS, recurring revenue business model. Well, platform is kind of a business model where you get to use the resources of third parties and kind of concentrate these resources in one system that is going to get out of that friction, get rent, get transactions out of those frictions and out of the transaction on this platform. I believe platforms are a very, very interesting business model. Happy to own Airbnb. Looking forward to owning more platforms throughout the 2020s. So this was it for my update. This is not investment advice. This is just entertainment. Please like, please subscribe, please comment. I really appreciate you all who follow me. I really do. It's so great. This YouTube journey is doing so well. I appreciate reading all of your comments. So thank you for your time, and thank you for following my channel. Have a wonderful day.